Good morning. Thank you. And thanks for inviting me to speak at this conference on lessons learned and challenges ahead for monetary policy. After a period of innovation and experimentation in monetary policy, during which the Bank of Japan has often been in the vanguard, it's certainly appropriate to step back and assess what we've learned and what we still need to understand. Some review and assessment are appropriate for me personally as well. As many here well know, I've been writing and thinking about Japanese monetary policy for many years as both an academic and as a policymaker. Much of my writing on Japan has been motivated by the unique, or at least initially unique, challenges that the Bank of Japan has faced in dealing with deflation and with the effective lower bound on short-term interest rates. As an academic, I found those challenges intellectually fascinating. The issues became much less abstract, though, of course, after I joined the Federal Reserve Board in 2002, and we found ourselves confronting similar problems in the United States, beginning with the deflation scare of 2003 and the American encounter with the effective lower bound starting in late 2008. I reviewed my old articles and speeches in preparation for this talk. My speeches in particular have been expositional, and I often tried to reflect the professional consensus of the time, including work by Paul Krugman, Mike Woodford, Gottlieb Eggertsen, and Lars Svensson, among others, as well as my own views. And in retrospect, much of what I wrote about Japan in the decade before the financial crisis has held up, I think, reasonably well. For example, my 2002 speech on deflation, plus papers in 2004 with Vince Reinhardt and with Reinhardt and Brian Sack, pushed back on the view, which had credence in some circles at the time, that when short-term interest rates are near zero, the central bank is, quote, out of ammunition. I argued instead that central banks have a number of options for easing financial conditions further after short rates hit zero. And my co-authors and I discussed and evaluated many of the policy tools that would be used in the American and Japanese reflation efforts, including forward rate guidance, both unconditional and conditional on economic developments, large-scale asset purchases, changes in the mix of assets held by the central bank, credit programs based on low-cost central bank lending, and even what in Japan is now called yield curve control. However, I did not anticipate negative interest rates. In other pieces, I argued that central bank purchase programs should focus on longer-term assets and not be concentrated on bills, as had been Japanese practice in earlier attempts at quantitative easing. I made the point that in the face of deflation risks, it was important not to try to conserve policy ammunition, but to move, quote, decisively and preemptively. I emphasized the need to set an inflation target high enough to provide some buffer against deflation, and I noted that temporary overshoots of the target to compensate for prior inflation shortfalls could be warranted following a period in which rates had been constrained by the effective lower bound. I frequently acknowledged the need to complement monetary policy with fiscal and structural measures, and I cited the critical importance of assuring financial stability through lender of last resort actions, financial regulatory reform, and bank recapitalization. However, I certainly did not get it all right. In particular, in earlier writings, I was too optimistic and too certain about the ease with which a determined central bank could conquer deflation, and I had little patience with the alternative view. For example, in a 2000 paper written when I was still an academic, I criticized the Bank of Japan for its, quote, self-induced paralysis and for showing insufficient Rooseveltian resolve. I asserted that more aggressive policies would certainly yield better results, just as Franklin Roosevelt's unorthodox strategies seemed to do in 1933, and indeed as Minister Takahashi Korikiyo's policies did in Japan during about the same time. But when I found myself in the role of Fed chairman, confronted by the heavy responsibilities and uncertainties that came with that office, I regretted the tone of some of my earlier comments. Central banks do have viable options at the effective lower bound, but the problem has proved less tractable in both the United States and Japan than I had suggested. In particular, in some of my early writings, I did not always demarcate sharply enough between what monetary policy can achieve on its own and what requires some degree of coordination with fiscal policy. At a 2011 press conference, in response to a question from a Japanese reporter about my earlier views, I responded, I'm a little bit more sympathetic to central bankers now than I was 10 years ago. Why ending deflation and escaping the effective lower bound has proved tougher than I once expected will be one of the themes of my talk today. In the remainder of my remarks, I'd like to do three things. First, I want to reaffirm the importance of the Bank of Japan's continued pursuit of its 2% inflation goal, notwithstanding the fact that on some important metrics, the Japanese economy today is doing well. Second, I'll comment in general terms on Japanese monetary policy since 2013, the first era of Abenomics. Although much progress has been made, even the very aggressive policies under Governor Kuroda have not yet achieved the inflation target. I'll discuss some aspects of the Japanese economy that have made reaching that goal difficult. Looking forward, it may be that actions already taken, together with some lift from the global economy, will be sufficient to allow the Bank of Japan to reach its target in the next few years. There are no guarantees, however, and with some bad luck, the improvement achieved thus far could be reversed. The final portion of my remarks will be some speculations on the policy options that would remain in that contingency. As I've noted, despite progress, the Bank of Japan is still some distance from achieving its 2% inflation target, with core inflation, that is without energy and food, recently hovering close to zero. Should the bank just declare victory and give up? Some might argue that extraordinary efforts are no longer needed. Although Japan's economy is growing only slowly, that largely reflects longer-term forces, notably a shrinking labor force and slow productivity growth, factors which are not amenable to monetary policy. Indeed, as is often pointed out, on a per capita basis, Japan's growth has not been that much worse than that of the United States in recent years. The Japanese labor market appears tight, with unemployment near recent lows, and the employment population ratio for prime-age workers, recently at 73.3%, is higher than that of the United States, at 68.7%. This performance has been achieved despite some extraordinary headwinds, including the global financial crisis of 2008, the earthquake and tsunami of 2011, and the ripple effects of Chinese efforts to make the transition to a more inward-looking, services-oriented growth model. Consumption tax increases in 2014 were an additional drag on growth. So why continue the pursuit of the inflation target? Well, one argument that's made is that the combination of higher inflation, higher nominal interest rates, and higher nominal GDP growth would help to reduce Japan's heavy fiscal burden. As a back-of-the-envelope exercise, I calculated the change in the present value of future principal payments on JGBs that would be created by a hypothetical once-and-for-all increase in inflation and nominal interest rates from 0 to 2% beginning in 2018. So I'm basically assuming that all future JGBs are issued at 2%, and so there's no capital losses associated with inflation. I'm looking just at the capital losses with the outstanding stock of JGB. According to this calculation, a jump in inflation and interest rates immediately, or in 2018, to 2% would lower the value of Japan's debt-to-GDP ratio by about 21 percentage points. A substantial benefit, but perhaps not a game changer given that the ratio is currently above 200%. I'll say more about the fiscal implications of higher inflation later. Putting aside the fiscal issues, for me, the most important benefit of achieving the inflation target is that it will produce greater economic stability in the future by restoring the ability of monetary policy to respond to recessionary shocks. Over the past 2 decades, that ability has been limited by the proximity of short-term rates to the effective lower bound. Now, to get a rough sense of how important this constraint has been, I estimated a standard Taylor-type rule for Japan using monthly data and looking at the periods from before 1995 where interest rates first came close to zero. So a Taylor rule, of course, regresses the policy rate on inflation and unemployment, basically. I did a very simple thing. I made no adjustment for changes over time in the inflation target, the natural rate of unemployment, or the neutral interest rate. But despite these simplifications and very simplified approach, the estimated coefficients are reasonable and look similar to those found for Taylor rules in the United States. And I refer you to my paper for a figure and more details. Now, with this estimated Taylor rule in hand, I used it to forecast out of sample how the call rate, the policy rate, would look in the post-1995 period assuming that the Bank of Japan responded normally to changes in economic conditions, and hypothetically assuming that there was no zero bound on short-term interest rates. Now, actually, when I do this, the implication for the current policy is that the call rate should be between 1% and 2%. That is not zero, but it says basically that currently Japanese monetary policy is not constrained. I don't find this to be realistic. You get a similar result for the United States when you look at Taylor rule projections for the last couple of years. They're much higher than the actual policy rate. So I think what is happening is two things. First, that my simple analysis doesn't take into account the fact that the equilibrium interest rate has been declining very significantly. And secondly, that there's been an increase in the inflation target from something close to 0 to 2%. Both of those things would create an upward bias in my estimates of the projected interest rate. But I go ahead with this anyway because, interestingly, despite the very significant upward bias in the projection of the short-term rate, what I find is that using this equation, that the call rate, if there had not been a zero lower bound, the call rate might have fallen as low as -4%, not only during the global Great Recession of recent years, but also during the long Japanese recession of 2000 to 2003. As Kiley and Roberts have recently shown for the United States, this zero bound constraint and the fact that it prevents policy from fully accommodating shocks to the economy can significantly degrade economic performance over time. That's true not only because of the constraint the lower bound imposes on monetary policy, but also because the implied floor on real interest rates impedes capital investment and puts pressure on borrowers' balance sheets during the weakest phase of the business cycle. Indeed, I did some calculations. The real interest rate has been was far more volatile before 1995 than it's been since then, suggesting that real interest rates are not performing their sort of countercyclical function that they would without the zero lower bound. Now, of course, getting inflation up to target at 2% would presumably also raise nominal interest rates about 2 percentage points, and that would not solve these problems because the constraint would still be relevant, but it would probably meaningfully reduce them. So, in short, despite the improvement in the Japanese economy, I think there's still a strong case for the Bank of Japan to continue to pursue its target. In particular, if it wants to restore its ability to respond to future economic shocks, it needs to get interest rates up away from zero. Let me now turn to some issues bearing on recent monetary policy in Japan. Of course, the current economic policy regime is associated with Shinzo Abe, who became Prime Minister in December 2012. The Prime Minister's plan to rekindle growth and end deflation, dubbed Abenomics, famously included the three arrows of monetary policy, fiscal policy, and structural reform. With Abe's support, the Bank of Japan announced a new inflation target of 2% on January 22, 2013, and the new governor, Haruhiko Kuroda, took office 2 months later. Under Governor Kuroda, the bank has adopted the policy of so-called quantitative and qualitative easing, QQE, including purchases of exchange-traded stocks and other private assets, as well as of Japanese government bonds. As a result of QQE, the Bank of Japan's balance sheet has grown to the equivalent of about 88% of Japanese GDP by the end of 2016. For comparison, the analogous figures for the Federal Reserve and the European Central Bank are about 24% and 34%, respectively. The bank has also adopted modestly negative interest rates, although it has not gone as far as the Europeans in that direction, and has taken a number of steps to shield banks from possible adverse effects on their profits. More recently, the BOJ modified its policy framework by beginning to target the yield on 10-year JGBs, initially at around zero, and by committing to overshoot for a time the 2% inflation target. As I discussed in a recent blog post, I see both of these steps as constructive. In particular, committing to overshoot the inflation target is consistent with theoretical analyses that conclude that when short-term rates are at the effective lower bound, the central bank should compensate by committing to keep rates lower than it otherwise would when inflation rises. More generally, the overshooting commitment should help to quell speculation that the BOJ will abandon the fight against deflation prematurely. The adoption of yield curve control can be interpreted as a change from a quantity target, 80 trillion yen annually in JGB purchases, to a price target, targeting the JGB yield. As the BOJ has increased its share of outstanding JGBs, the remaining stock in private hands has become less price sensitive because banks and other holders value JGBs for reasons other than yield. Thus, even as it becomes more difficult for the BOJ to meet a fixed quantity target for JGB purchases, the bank will find it easier to manage JGB yields, and it will likely be able to do so with lower volumes of purchases than in the past. Since limits on the supply of JGBs in private hands will no longer be a barrier on the implementation of policy, the new framework is more sustainable than the previous one. Setting a target for JGB yields may also allow the bank to better project and manage the effects of its policies on the economy and on financial institutions. Well, certainly the policies undertaken since 2013, especially those by the Bank of Japan, appear to be having significant effects. Despite having little space to reduce the call rate, since Abe's election, the bank has effected a substantial easing in financial conditions, as reflected in the stock market, longer-term interest rates, and the exchange rate. Growth has picked up, averaging about 1.1% since the beginning of 2013. That's above potential, consistent with the improvements we've seen in the labor market. After years of contraction, nominal GDP growth has averaged close to 2.1% annually over the past 4 years, which is a positive for fiscal sustainability. And importantly, there are signs that the long deflation has ended, with core inflation during 2013 to 2015 in the range of 0.5 to 0.7%, excluding the change in the consumption tax, although worryingly it has dropped close to zero in 2016. When Hausman and Whelan, in a paper at the Brookings Institution, did an early review of Abenomics and BOJ policies, they concluded that it easily passed the cost-benefit test, and 3 years later that assessment looks to be holding up. Still, the BOJ's stated objective of 2% inflation has not been reached, and the timeline for achieving the target has been repeatedly pushed back, which is disappointing. Why? From my perspective, it looks like some features of the Japanese economy and the legacies of past policies are interacting to prevent faster progress toward the BOJ's inflation objective. Importantly, the equilibrium real interest rate in Japan appears to be exceptionally low, probably negative. The equilibrium real rate, known to economists as R star or the Wixelian rate, is the real interest rate at which aggregate demand and potential output are equal. Equivalently, the equilibrium rate is the rate that defines a neutral stance of monetary policy. That the equilibrium real rate in Japan would be low is hardly surprising. Indeed, there's considerable evidence that R star has fallen to historically level in all the major economies. Broadly speaking, there are at least two explanations for the low level of R star in the leading economies. The secular stagnation hypothesis, advanced by Alvin Hansen in the 1930s and recently revived by Larry Summers, holds that the main driving forces of lower rates are persistent downshift in economic growth and an associated decline in the returns to capital investment. Alternatively, the global savings glut hypothesis, a phrase I coined in a 2005 speech, focuses on the global imbalance between high desired savings and low desired investment, which also puts downward pressure on real interest rates. This view emphasizes that some excess saving is the result of policy decisions, such as the accumulation of large war chests of foreign reserves by some countries. The two hypotheses are not mutually exclusive, and indeed they're complementary. If there were no tendency towards secular stagnation in major economies, then capital investment opportunities would be sufficient to absorb global savings at a higher level of real interest rates. If there were no global savings glut, then secular stagnation in one country could be overcome by its residents investing abroad, including in emerging markets, through capital outflows and trade surpluses. Both hypotheses appear relevant to Japan today. Japan's declining labor force and slow productivity growth are consistent with the secular stagnation view. Together with Japan's high current ratio of capital to labor, weak growth prospects depress the marginal returns to domestic capital investments. Moreover, an aging population with slowly growing real incomes will have limited demands for consumer durables or housing. In textbook terms, the IS curve is very far to the southwest in Japan, implying that very low or negative real interest rates are needed to get the economy to full employment and to create upward pressure on inflation. The secular stagnation argument emphasizes the low return to domestic investment opportunities. For Japan, capital outflows have been an important alternative use of domestic saving. In principle, such outflows should afford Japanese savers higher returns, while also weakening the currency, promoting exports, and maintaining full employment at home. Of course, Japan's ability to benefit by this mechanism is limited by the extent that other major economies are also suffering from slow growth and are themselves contending with the effective lower bound on interest rates. Ideally, Japan's excess savings not absorbed by other major economies would flow to capital-poor emerging markets, but this channel is narrowed by the global savings glut and policies aimed at promoting trade surpluses and reserve accumulation in many countries. Other factors that block the foreign investment safety valve and thus depress R-star in Japan include the strong home bias of Japanese savers, international political constraints on the size of the country's export surplus, pricing to market behavior by Japan's exporting firms, which reduces the elasticity of exports to changes in the exchange rate, and the yen's status as a safe haven currency, which means that it tends to appreciate at times of global economic, financial, or political stress. A low R-star, a low equilibrium real interest rate, together with low inflation rates, challenges the ability of monetary policy to reflate the economy. Again, that's not to say that central bankers are helpless in that situation. In general, even at the effective lower bound, monetary policy can still boost aggregate demand in one of two complementary ways, either by easing financial conditions, for example by lowering longer-term interest rates, depreciating the currency, or lifting the stock market, which stimulates aggregate demand directly, or by raising the public's expectations of inflation, thereby lowering real interest rates as well as increasing expectations of future growth. In standard models with rational expectations, these two methods are just the opposite sides of the same coin. In particular, at the effective lower bound, monetary policy can ease financial conditions only to the extent that it affects inflation expectations. However, in practice, I think it is important to maintain the possibility that the two channels, the two approaches, are behaviorally distinct, in that at least some segments of the public could respond differentially to changes in financial conditions and hold different expectations about inflation and growth. In any case, in Japan, both channels of monetary policy transmission seem to be approaching their limits. First, today, not only are short-term interest rates in Japan at or near their effective lower bound, but so are very long-term rates, a sort of super liquidity trap, if you will. In contrast, even though U.S. short rates remained near zero from 2008 through 2015, long-term rates remained well in positive territory, with the 10-year Treasury rate never falling below 1.5%. So despite having no room to cut short-term rates, the Fed was able to ease policy by putting downward pressure on longer-term rates through forward guidance, quantitative easing, and other tools. Likewise, as already noted, the Bank of Japan has been able to ease financial conditions substantially in recent years, despite having little room to navigate at the short end of the yield curve. However, now, with the whole term structure effectively at zero, and with the BOJ apparently unwilling to go significantly negative for financial stability reasons, the scope for substantial further easing of financial conditions in Japan, even through unconventional tools, seems somewhat limited. Alternatively, as noted, the BOJ could lower real interest rates and stimulate activity if it could generate expectations of increased future inflation. For example, by promising to keep rates low even when inflation begins to rise at some point in the future. Are such promises credible? There does appear to be evidence that central banks can make credible promises about the future, even if the promises are not fully time consistent in the technical sense. Inflation targeting itself is not time consistent, according to simple models like that of Barrow and Gordon, in that in such models there is always an incentive for policymakers to engineer an inflation surprise and enjoy the resulting boost in economic activity. Yet, in practice, inflation-targeting central banks have been able to establish credible frameworks and to anchor inflation expectations at target. The global experience also suggests that forward rate guidance, some commitments about future policy, can ease financial conditions, even if the forward commitments made by the central bank are less than precise. And some of the effects of quantitative easing, indeed, appear to be due to signaling about future rate policy. So in general, the use of central bank talk to manage expectations should not be ruled out as a tool of monetary policy near the effective lower bound. One would expect such management to be especially effective if the central bank both demonstrates its resolve and if the government clearly supports the strategy, hence the potential significance of the dramatic changes under Abenomics and the need for bold action that I stressed in my early writings about Japan. Inflation expectations in Japan did rise after the initial announcement of QQE, but overall they have been less responsive than had been hoped, particularly when headline inflation was depressed by declining oil prices and other factors. It's sometimes said that Japanese inflation expectations are adaptive, or that institutions like national wage bargaining lead to backward-looking behavior. These are less explanations than just different ways of restating the basic puzzle, that inflation expectations in Japan have seemed overly sensitive to current developments and relatively unresponsive to central bank talk, even when that talk has been accompanied by vigorous measures such as large-scale asset purchases. There are various ways to rationalize the weak response of inflation expectations to BOJ communications. For example, households and firms have limited bandwidths, so that in the absence of good reasons to the contrary, they don't spend much time or mental effort updating their beliefs about inflation. Given the quiescence of inflation, that strategy would not have been very costly for private agents in Japan in recent years. Alternatively, people may have good information but still behave like Bayesians, updating based on actual inflation the probability that Japan has shifted from a regime with low inflation to one with higher inflation. And so far, the evidence for putting weight on the higher inflation regime is obviously limited. Both of these stories put some blame on earlier policies of the Bank of Japan, which allowed the deflationary mindset to become entrenched over many years. As another related possibility, Krugman has offered a multiple equilibrium interpretation of the stickiness of inflation expectations. Suppose that for some reason people come to expect relatively high inflation. With nominal interest rates at zero, the expectation of high inflation drives down real interest rates and pushes up activity and prices, confirming the initial expectation. But if people instead persist in expecting low or zero inflation, then real interest rates don't fall, and that inflation expectation is also self-confirming. This multiple equilibrium story seems a reasonable description of the BOJ's dilemma. If for whatever reason people don't expect inflation, then it's hard to generate inflation, which only confirms the public's skeptical view. As I recently discussed at a comment at Brookings, and as I believe Mark Gertler will say something about later in the conference, understanding the links between central bank talk and the expectations of households, businesses, and markets is an increasingly important challenge for monetary policymakers. As I noted, the evidence suggests that through reputational capital or other mechanisms, central bankers can induce expectations of future policies even when those policies are not fully time consistent. But how best to manage expectations, particularly when contemplating a shift from one set of steady-state policies to another, remains unclear. Japan's experience illustrates how difficult such management can be. The Bank of Japan has made important progress since 2013. Policy has been much more forward-leaning, as was necessary given the powerful grip of deflationary forces. As I've discussed today, the BOJ's actions have significantly eased financial conditions, promoted general economic recovery, and brought inflation into positive territory. It may be that the BOJ's new framework, together with fiscal policies in the pipeline, will deliver enough stimulus for the bank to achieve its inflation target over the next couple of years, particularly if the global economy cooperates. However, the situation is not entirely comfortable. Inflation is still well below 2% and not decisively on a path to target. And the tools used in the past few years are running into limits, as I've discussed. In particular, interest rates are close to the effective lower bound not only at the short end, but throughout the entire term structure. And in the absence of persistent increases in realized inflation, expected inflation has remained low. While it's not clear at this juncture that the BOJ will have to do more, we can't rule out that possibility for the future. So at this point, what's left in the toolkit? Blanchard and Posen have argued that to increase inflation expectations in a situation in which expectations have an important backward-looking component, it's important that actual inflation be pushed up first. They recommend that the government take advantage of Japan's semi-centralized wage bargaining process to pressure and cajole firms into granting larger nominal wage increases, and to pass those increases along into prices. The government sector could do its part by granting wage increases to its own workers. The government has, in fact, tried a little bit of informal pressure on wage bargainers. If successful, pressuring firms for wage and price increases could lead to higher inflation expectations, at least for a time. However, although higher wage income would presumably increase consumption, there's no guarantee that aggregate demand would rise enough to be consistent with full employment at the higher price level. If not, then the price and wage increases would ultimately be temporary, or in analogy to the unsuccessful U.S. wage price controls of the 1970s, firms would find ways to game the system that allow them to maintain profitability while perhaps still reporting that they have higher wages and prices. Whether it chooses to engage in an incomes policy or not, and to be clear, I'm taking a neutral position on that, the government must still ensure that aggregate demand is sufficient to sustain higher wages and prices. Assuming again that we are several years down the road and inflation has not returned, how could that be done? When central bank action on its own reaches its limits, then fiscal policy is the usual alternative. However, in Japan, even fiscal policy may face constraints resulting from the high debt-to-GDP ratio that already exists in Japan. This leads inevitably, I think, to discussions of coordination between monetary and fiscal policy. There are many ways that such coordination could be implemented, but the key elements of a possible approach are, first, that the government commits to a new program of spending and tax cuts, and second, that the central bank promises to act as needed to offset any effects of the program on the path of Japan's ratio of government debt to GDP. So, fiscal program, central bank backs it up by keeping the debt to GDP ratio from rising. As I said, there are various ways that this promise could be implemented. A direct approach, consistent with the arguments of Krugman and Eggerson and Woodford, would be for the BOJ to commit to a temporary overshoot of its inflation target sufficient to avoid any increase in the debt-to-GDP ratio. This commitment amounts to a promise of monetary financing of the fiscal program without relying on exotic concepts like helicopter drops. To illustrate the possibilities, I extend my earlier analysis of the effect of inflation on Japan's debt burden. Given the maturity structure of currently outstanding JGBs, the BOJ could effectively finance a fiscal program sized at 2% of GDP by holding inflation 0.7 percentage points above its target for 3 years, or 0.4 percentage points above target for 5 years. Further, that calculation ignores any increase in revenue that might result if easy monetary and fiscal policies spur growth in nominal GDP. For its part, the government could reduce the degree of inflation overshoot needed by financing its program through long-term debt, which would be most affected by an increase in inflation. I won't discuss here the composition of this hypothetical fiscal program, except to note that it might be worthwhile to use it to advance the structural reforms that are the third arrow of Abenomics, and which are essential for increasing growth in the long run. For example, retraining programs and income supports could reduce the resistance to reform of less efficient sectors, and targeted social services could facilitate increased labor force participation by women and older people. Now, it seems reasonable and consistent with much empirical evidence that a well-designed fiscal program would increase aggregate demand and output and, via Phillips curve effects, ultimately put upward pressure also on inflation. Notably, fiscal policy does not rely solely on changing expectations about future inflation or output. We might still ask whether the monetary component of the proposed program would be necessary or helpful. I'll briefly address two arguments against making yet another commitment by the central bank. First, one might wonder whether a commitment by the BOJ to offset the increase in debt through higher inflation would be any more credible than other commitments it has made to increase inflation, including those supported by large-scale asset purchases. If Japanese households and firms maintain the skeptical attitude of recent years, the BOJ's announcement would not change inflation expectations, and one could argue the monetary element of the program would have little benefit relative to the fiscal program taken by itself. The possibility that inflation expectations can remain sticky even in the face of strong fiscal and monetary actions, is the flaw in the argument I once made that a determined central bank can always raise inflation. In the context of my proposal, however, it may not be necessary for the public to believe the central bank's claim that it will allow an overshoot of inflation. It may only be necessary that the administration and the legislators believe it. Presumably, a key reason that a government might not approve an expansionary fiscal program at a time when it is warranted by macroeconomic conditions is concern about the resulting buildup in the national debt. If legislators believe that monetary policies would be used to offset that buildup, they might be more willing to act. Moreover, they would understand that monetary policy would not lean against the expansionary fiscal actions, but instead would allow the multiplier to increase and provide more bang for the buck. So the purpose of the monetary fiscal coordination, as I've described it, is not to augment a given fiscal program with central bank promises, or not only to do that, but rather to make the fiscal program politically feasible in the first place. Of course, to the extent that the central bank honors its commitments to allow a temporary overshoot of its inflation target, the impact of the combined program would ultimately be all the larger. A second concern about this proposal, about possible close coordination of fiscal and monetary policies, is that it would violate central bank independence. When I last spoke at a Bank of Japan conference here in Tokyo in 2010, I laid out in some detail the case for the independence of monetary policy from short-term political pressures, combined, of course, with transparency and accountability, which is essential in a democracy. Narrowly, the case for central bank independence turns on avoiding an upward inflation bias that can result if politicians pressure monetary policymakers to be too expansionary or to be a regular source of government finance. Upward inflation bias does not appear to be a problem in Japan, to put it mildly. A more general case for independence argues that distance from politics allows monetary policymakers to be more objective and scientific, to achieve greater consistency and continuity in policy, and in general to take a longer-term view. And that perspective I find compelling. So would coordination with fiscal policymakers in the way I've described endanger those values? It would be important to define clearly the commitment that the central bank is making. For example, it would have to be clear that the commitment to aim for temporary inflation overshoot applies only to the current program and is not ongoing. Moreover, it's understood that in all circumstances, the central bank would retain control of the tools of monetary policy, implying that, for better or worse, the government has to accept the risk that a future leadership of the bank would renege on its commitment. It seems to me that such an agreement, if it could be struck, would not violate independence any more than, as I once argued, a treaty between two independent countries doesn't violate the principle of sovereignty. We must also remember that central bank independence is a means, not an end. A central bank's independence is threatened when it faces pressure to do something outside of or contrary to its formal mandate. That's not what would be happening here. In this case, the central bank would be cooperating with the fiscal authorities for the express purpose of achieving its mandate. Well, to conclude, Japan has made substantial economic progress in recent years, including progress toward the Bank of Japan's 2% inflation target. Unfortunately, inflation remains below the target despite the BOJ's aggressive approach under Governor Kuroda and the general improvement in the economy. If monetary policy is to once again be a useful tool for fighting future recessions, getting inflation up is essential. If all goes well, the BOJ's current policy framework may yet be sufficient to achieve the inflation objective. We'll have to wait and see. If not, there are relatively few options available. The most promising possibility, should we get to that point, is more explicit coordination of monetary and fiscal policies. Monetary policy that is aimed at limiting the impact of fiscal expansion on the government's debt could both make fiscal policymakers more willing to act and increase the impact of their actions. The BOJ might be reluctant to take such a step. In the possible future state that I am contemplating, however, there would be no real alternative other than to abandon the fight to raise inflation and perhaps even to accept a new bout of deflation. After such a long and valiant effort to end deflation and raise interest rates from their effective lower bound, that would be a most disappointing outcome. Thank you.